Pfizer has crashed. It is down now towards a new 52-week low, and in fact down around 12% just year to date. So why is it crashing? Is it now an incredibly strong undervalued play? We can in fact see 3 analysts all indicating it is a buy, and it does currently offer a very nice starting yield of 6.61%. So in today's episode, we are going to do a deeper dive. We can also see that just over the last 12 months, it is down 34%. So is this one that we should be adding? I'm going to talk about my own strategy, whether or not this is one that we really need to add in our portfolios, not just for dividend growth, but also for the long-term growth of this company. As always, we are going to go through the numbers of this company. We're going to look at their top line revenue growth year on year, their bottom line net income. We're going to get an updated look at the health of the company, their total cash versus their total debt. And we want to look towards both insiders as well as institutions to understand if they have been buying or selling. We will talk a little bit about the upcoming earnings from this company, what we expect, and we also want to draw out some interesting facts from their latest acquisition and how this will really help propel the company back to the numbers, back to the highs that we did see in COVID. What we also want to discuss is a few points from their latest guidance, what we expect them to report over the next few quarters, and also we do want to touch upon their pipeline and understand whether or not out of those different phases there are some new items that they can bring out to really strengthen the growth moving forwards. As always, we also take a look at the valuation of Pfizer. We want to look at the intrinsic value, see what our acceptable buy price is given our investor margin of safety, and look towards Wall Street to see what they expect in terms of growth and upside over the next 12 months. So let's just remind ourselves of the historical performance of this company. Now it is down 34% over the last 12 months. If you have been a longer term shareholder, you would be down negative 13%. Although bear in mind, if you were to reinvest those dividends, you would be up slightly higher. And it has had a massive fall from the highs that we did see at the back end of 2021, where it was nearly at that $60 mark. In fact, it is lower than half the price at that point as well. As we mentioned, at its 52-week low, pretty much there or thereabouts, and it does have a nice forward starting yield. So when we take a look at this company, just on the top line growth, now this is important for the rest of the episode, what we do want to see at least 3 to 7% growth year on year. What we can see, a bit of a roller coaster. Now they reported just under 50 billion in 2014. When we look at 2023, 58.5. Now, you may think that's not much growth over that period, but when you do take a look, and we can see via the graph, it did in fact peak at December 2022. As we all know, COVID had a very positive impact for their top line, and it has in fact since then come down dramatically. So this episode is about identifying if they will be able to increase this back up and continue to the levels that we would expect for a growing company. Now, how has the bottom line performed? As we saw, the top line did look very inconsistent. We note that the bottom line also shares that approach. 9.1 billion in net income in 2014. In fact, December 2023, 2.1 billion. Again, whilst the top line did in fact increase, we see the bottom line decrease, but we also note the 2 years before that, in fact the last 3 years, when it was going through that COVID period, some very high numbers on the bottom line. And again, when we do look at it from the graph, a lot of inconsistencies year on year and a massive drop into 2023. Now, how does that look in terms of the balance sheet, so the health of Pfizer? As always, what we do want to see is cash versus total debt. 36.1 billion reported in cash and short-term investments in 2014. We then see 12.7 billion in their latest quarterly report. So their cash has dropped significantly over the longer term. Now, there is a reason for this. They have been doing acquisitions both organically as well as buying other competitors, and we will talk about that as well, notably one very large one just at the end of last year. But what we can see when we take a look, very inconsistent over the period as well. Again, during those COVID, that pandemic years, we do see some very high numbers on their cash, which is no surprise as we do see some very high revenue and bottom line net income during those same periods. Now, as always, we do like to compare it to the total debt numerically and directionally. And what we can see here, it has in fact pretty much doubled over the last 10 years, going from 36.7 billion in 2014 to around 75 billion in that latest quarterly report. So One thing that we do want to discuss as well in this episode is the dividend safety. We are seeing that the cash has reduced by a significant amount, whilst the debt has in fact essentially more than doubled. So with this company, they are offering a very nice starting yield, but you also want to understand if they will be able to maintain that. Now, a few things that we like to incorporate into our analysis. First one is some growth grade metrics. So we see they get a C+. Now, the reason for this, a few things we want to point out. Year-on-year revenue growth, no surprises from our analysis just a minute ago. Negative 42% with the sector median at just under 7%. When we take a look at it on a forward basis, negative 15% projected, and we see the sector median are having a high single digit number going forwards. On top of that, another metric that I like to keep a close eye on is the earnings per share on a forward basis over the next 3 to 5 years. They are expected to increase it by just under 10% when we see that the sector median is sitting around 11.04. There are also other metrics that we can clearly see they have underperformed, the EBITDA as well as the EBIT growth. So again, do understand this, and we will factor this in when it does come to our central margin of safety and our investment thesis throughout the episode. Profitability grade, well, pretty strong considering their growth was terrible, so we have an A+. So what this forms part of is the gross profit margin. We can see 59%, with the industry leaders on average coming in at 56%. When we take a look at the bottom line, 3.6%, so that is positive, especially when you consider that the sector median in fact are making a net loss of around 5.54% negative. We also have other metrics, but overall you can see some very strong performances. We can also notably point out their cash from operations, 8.7 billion, when others in the industry are in fact having negative cash. So quite positive on the profitability, the opposite to what we saw just now on the growth grade. Again, different things for us to factor into our investment thesis and analysis. Now, in terms of the total return over the last year, we are looking against competitors in the pharmaceuticals. We have Roche Holding AG, we have Bristol Myers, which we did review a few days ago, as well as others. Again, all of these we have reviewed on the channel. Do check out if they do interest you. Bear in mind what this means. Total return includes those dividends reinvested, negative 31%, the worst performing. Now we extend this to the last 5 years, negative 18%, a little bit better, but still, granted you can't predict the future. You don't want to be investing in a company where it does have a negative over a 5-year period and when you are reinvesting those dividends. When we extend it to the last 10 years, yes, it is positive 27%, but let's be honest, if you are putting money into a company or anywhere and over a 10-year period you are only getting 27%, if you were to factor in inflation, you probably in real terms would be negative. So they haven't had the greatest last 10 years, but hopefully in this episode we can take a look and see whether or not we do believe over the future they will look to increase their outlook and have much better returns. But as always, we do like to remind you that past performance is never an indicator of future performance. Insider ownership, 0.06%. Just one notable insider buy over the last 12 months for around 156,000, which we will come up on. So as you can see, over the last few quarters, very minimal movement on insiders, although we can see insider buying a very significant amount Q1 2023. We see some in Q2 of 2023, as well as here Q4 of the same year. And then when we take a look at the insider buys, we can notably see there are some US Congress members buying and selling, not something that we typically include. We have to go as far back as essentially the middle of December 2023 to see Scott, the director, buy around 3,000 shares. Now, given this was for an amount of 79,000, yes, insider buying, we do like to see it as a bullish signal, as insiders buy because they believe the share price will go up. This isn't one that we would say that you could really include in your investment thesis, just given the amount is fairly trivial. But again, every investor will have their own preferences, and there is no harm at least putting it in. When we take a look at institutional ownership, what we do see is 68.36%. We see outflows of 10.74 billion over the last 12 months, and we see around 86 billion of inflows over the same period. So when we take a look at this, over the last 12 months, institutions have been buying a lot more than they have been selling. When we look at the more recent quarter, however, we do see a little bit more buying than selling, as well as over Q4. So not just over the last 12 months have these insiders been buying a lot more, but also in Q1, so the latest quarter, we see a little bit more buying as well. So quite interesting to note. But as always, we do like to inform you that we should never buy or sell any shares based on institutions or insiders, and always do your own due diligence. Now, a few things that we wanted to point out from here. So earnings next week is looking very big. We have some very, very big notable companies. But given this is an episode purely on Pfizer, we just wanted to make you aware that they will be releasing their earnings before the market open on Wednesday. So a few things that we will consider when we take a look at their forward guidance, just to understand whether or not we do believe that over the next quarter or two, we will see some very strong numbers. Now, the first thing that does really bring us into Pfizer and their numbers is their acquisition of Seagen. Now, we have talked about this on other episodes, so very briefly, we just want to point out they did spend around $43 billion on this company. When we take a look at their balance sheet, we can see their cash has come down over the last few years. And again, this was an acquisition that they did make from their cash. So we can see something just to consider, one of the reasons why this position has started to come down. So on top of that, 43 billion, as we discussed, essentially for those that are new, it is a global biotech company, a very big one, that do in fact discover, develop and commercialize transformative cancer medicines. The reason why we are talking about them, it does impact their numbers, and this will be shown now when we do take a look at essentially their latest quarter earnings. So this was released around 3 months ago, the end of January, and a few things we did want to point out. The first one being, and unfortunately the sad reality of the world is that 1 in 3 people will be diagnosed with cancer in their lifetime, and this essential acquisition will be at the forefront of stopping or helping eradicate this. What we can see here, essentially the acquisition is expected to double the size of their oncology pipeline. And on top of that, what we can see is their medicines are expected to immediately enhance Pfizer's top line growth. So we aren't talking about something that will be needing to go into trials and take a while. This is expected to have immediate enhancement on that number. And on top of that, it is expected to deliver at least 8 potential blockbuster products by 2030. So we're talking about over the next 5 to 6 years, seeing some very strong improvements on their top line. And in fact, for the greater good of the world, as we can see here, lots of positive medicines. Now, when we take a look at how the numbers will be impacted, this is what we were trying to explain. Over the course of this year, over the course of the next few quarters, we should see the enhancement of Seagen in 2024, 3.1 billion. Now, that may be not a large amount right now, as we can see, just based on their 2023 numbers, we are talking about less than 10%, in fact around 5 to 6%, but we can see it is having that immediate impact that we were expecting based on what they had just said, and this is one that will be good to look at when they release their earnings, at how much it has hit in terms of what they were expecting, whether or not it is lower or whether or not it is higher, and that will give us a good gauge of 2024 on Seagen and the impact that it has had in spending that 43 billion to acquire them. Now, in terms of their growth into 2024, so we can see now 58.5 to 61.5 billion in comparison to how that looked to 2023's number. We can see that the lower end, what they are expecting at a minimum, is their 2023 number, so it is expected to be flat. They are hoping ideally it will be towards the upper end at 61.5 billion, but as we can see here, these are the numbers that they are targeting. In terms of the earnings per share, well, 184 was what they reported in 2023. They are expecting now, as we can see here, around 205 to 225, so some growth on the EPS numbers. Now, this is just the 2024 numbers, and as always, if you are investing for the long term, you do need to think about the bigger picture, and hopefully we will see not just 2024, but as the years do go on, some very strong impacts from this acquisition. Now, a few things just to point out, in fact, 3 different things. The way that they do like to deploy their cash, as they have had a lot of it since COVID, the pandemic. As we mentioned, their revenue had increased, their bottom line had increased. First one is the reinvestment. So in FY full year, in fact, 2023, they spend just under 11 billion in their own internal R&D. We're going to come to the pipeline shortly just to discuss this. And they do also pay significant amount in dividends. As we mentioned, it is currently now towards the 7%, in fact 9.2 billion. And they are also looking to do some share repurchase. However, just bear in mind, as we can see here in the 1 point, no share repurchase were completed in 2023. And they do say here current financial guidance does not anticipate any share repurchase in 2024. Now, A little bit sly that they have got that on this slide and they have put here, but I did want to point out that even though they have this on one of their 3 pillars, that in fact 2023 they bought no shares, 2024, based on this information, they aren't looking to do any either, but we will be eagerly anticipating the slide deck that they do release in the next quarter. In fact, not too long now to see whether or not they will in fact incorporate some share buys this year. Now, for those that don't know, it is very important to always take a look at the pipeline of these type of companies, the biotech pharmaceuticals, to see what they have that is going to come out, that is going to increase their top line from an investor perspective. Now, they have 112, they call them candidates. The reason for this is because obviously not every single one that they bring out will come into production. And when we take a look at the different types, we have phase 1, phase 2, phase 3 and registration. Now, in the previous episode, we did a very high level look at this. The thing that I did want to point out, because for me as well, this isn't exactly my profession, this isn't what I understand, but we can take a very quick look at the information. Now, the way it works is the clinical trials are divided into 4 different segments. They've only discussed the first 3, but you have essentially phase 1, you have the phase 2, and you have the phase 3, which are the ones that are very common. And then finally, you have the registration. So essentially, this is an important one to look at. The registration is after phase 3, and if essentially everything works out well, it will be submitted to the FDA, which is the Food and Drug Administration. From that, once they are reviewed, or in fact the review process alone does take 1 year, so something we do need to factor in when we are taking a look, but we can see the numbers that they have in the different phases. Registration, so that is towards the end, they have 6, as we can see here, in the different areas of focus. We have anti-infectives, we have a few vaccines, as well as some intermedicinal things. And we can see here finally at the bottom, oncology as well. So these are also noted as project advanced. Remember, from this point, it could take up to a year. So we do see quite a lot that is in their backlog that they are trying to work through. And this has been updated from their latest quarterly earnings. So over the next few weeks, we will do a very quick analysis of how they have improved, how this process has gone along over the last 3 months, but something always good to look at. Now, before we do jump into their dividend safety, as they do offer a very high yield, just to let you know, we have released our latest free weekly article. We do discuss in this whether or not it's better to lump sum or dollar cost average. We have other articles. Now, we get a lot of messages in the comments talking about what websites do you use. Well, this article runs through every single website that we go through, so you do have your own. You can go and analyze as well. We also go through stocks with massive upside, undervalued dividends, as well as other things as well. Instant access, if you do click below, it is all free to read straight away. As we can see, a 75 score on their dividend safety. It does look to be safe, as well as a market cap of 144 billion. It is a mega cap company. Now, what we can see from time to time, they do in fact take a look at the dividend safety to update it. March 22nd, so last month, they did in fact reaffirm that the dividend safety 75 does look very safe, and in fact we can see that a dividend cut is unlikely. Now, when we take a look at the recessionary metrics, as always, the last recession, 07-09, they in fact cut the dividend. They didn't maintain it or increase it, so not great for shareholders at that point. They had negative 6% sales. This was above the average growth. In the S&P, it was around negative 12, and they also outperformed the S&P, negative 45, with the S&P coming in at a negative 55 recession return. Dividend growth, now last December, we do see 2.4%, so pretty poor, in fact, below the 4% that we always advocate on the channel just to keep up in line with inflation. However, over the last 5 years and the last 20 years, between 4 to 5%, so at least with a nice starting yield of 6 to 7%, they do increase it in line with inflation. We also know they have been increasing those dividends for the last 13 years. Dividend yield theory, now for those that are new, it does state a company is undervalued when the current yield sits above the 5-year average, so we have a massive undervaluation signal here. Bear in mind though, we don't look at any of these models in isolation and will conclude towards the end. We also note the forward P does sit marginally lower, 11.5 versus the 5-year rolling of 12, and we can see it is significantly lower than the healthcare sector at 17.3. Now, in terms of looking at the payout ratios, what we can note here is that below 60% is my own personal blanket rule. Below 60 gives me faith that management are able to offer those double-digit dividends we love to see. And as always, we do ignore the earnings, which is susceptible to manipulation by management through accounting. One of the reasons is, if you were to look at 2023, what we can see is 193%, a massive red flag indicator. The reason for this, it means that management paid out more in dividends than they generated in free cash flow, something you wouldn't be able to deduce from the earnings. And we can also see another red flag indicator in FY24. It is expected to be over 100%. Now, something just to consider, again, as always, in your investment thesis as well as your margin of safety. Free cash flow, what you want to see is increasing free cash flow. Now, what we actually know is it wasn't too bad up to 2022, although in fact this was the pandemic era. Before that, we do see it was fairly flat. FY23, it did decrease down to 85 cents. However, FY24, we do see it at 157, and in fact, it is expected to increase, which is positive, and hopefully with the acquisitions they have done and what is in their pipeline towards the latter stages, we can see these increase. Sales growth, no surprises here. Whilst we do want a borderline 3% to 7% as our target, we can see FY23, that massive decrease due to the massive growth that they had during COVID. And in fact, before then, we do see it very, very poor. In fact, negative most years, or at least flat. What we do see then, and we did look at this earlier numerically, their top line has been very inconsistent. FY24, as we ran through, is expected to be roughly the same as 2023. Shares outstanding. Now, returning excess cash to shareholders is what we love when companies buy back those shares, effectively giving you a larger portion of the company. Now, yes, they have been doing that over the longer term. However, do remember that when we did take a look at that slide, that they hadn't done any share buybacks in 2023, as well as the fact that in 2024, they aren't anticipating to do so. ROIC, then, we do want to see around 10% to give us faith that management are able to effectively allocate their capital. FY23, we see a massive drop, but again, when you remove that COVID era, we do see it straddle around that level. 2023, just not a great year, something we will take a look at when the next annual report is released. Operating margin, again, up to 2022, very strong. It did drop, and again, when we did take a look at some of those metrics earlier, we did note that it wasn't the greatest. But again, as long as they can find a way to come back up, which I do believe over the longer term they will, then it should be okay. Free cash flow margin, whilst very, very poor in 2023 compared to the previous years, it is still above the minimum that we want to see. Hopefully, they will find a way to get back up higher. Net debt to EBITDA, then the earnings before the interest, tax, depreciation, amortization. As always, this corresponds to both dividend safety as well as balance sheet strength, below 3 for the majority of companies, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. And what we can see here is FY24, they are expected to bring it down from the highs we saw in 2023, which is a very positive sign, and if they do manage to keep that downward trend, but something we will definitely keep an eye on. As always, if you enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model we are taking a look at is the dividend discount model. Now we can see the yearly dividends. It comes to around 3.14%. So forward looking, we've gone a little bit lower than the average just to be a little bit more conservative. And we get an intrinsic value of $34.61. We have our first undervaluation signal, but bear in mind we don't look at any of these models in isolation. We then have the DCF model with the free cash flow year on year. What we can see on average around 3.43%, and we do go for around 6%, slightly lower than management and analyst targets to be a little bit more on the conservative side. In conjunction with the discount rate, we do get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, and divide by shares outstanding to get our intrinsic value of $31.75. Again, another undervaluation signal. One thing we do want to point out with this model, we have used for 2024 the pre-COVID levels of 10.542. As we can see, it was very high from 2020 to 2022, and 2023 it did drop. So two essential assumptions we have used. First one is the growth rate of 6%, and the second one is that in 2024 we expect those essential free cash flows to be the pre-pandemic numbers. So when we take a look at the intrinsic value, it is just the average of these two models, and the reason why we haven't used Graham's or multiples in today's episode is due to the fact that the earnings per share on the trailing 12-month basis is extremely low and would make these numbers very, very skewed. When we take a look then at the intrinsic value, $33, we get a current price of $25.40, and as always, we do use a margin of safety of 10%, which we only execute if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Then what we do is we keep going till it's near the current trading price, and right now we can see it doesn't quite get the 25% margin of safety, but at a 20% level we can see the acceptable buy is around 26.54. So today's episode, the margin of safety based on the estimates and judgments is 20 to 25%. How about Wall Street? Well, as we can see, they have a price forecast of $31.57. They see upside of 24%, indicating it to be a very strong buy. As we did take a look at the beginning of the episode, all three analysts considered Pfizer to be a buy. Now, in terms of my thoughts, as we do all know, the earnings is coming very soon, in fact, over the next few days, and I will be looking to see if there is any strength in the numbers, any improvements to what the analysts are targeting, as well as the forward guidance. This is one that over the last few weeks I have considered to add to my portfolio, and in fact, if I do see some nice strength in the numbers, in their guidance, as well as beating analyst targets, this is one that I could consider for my portfolio. It does also have a very nice starting yield now, nearly at that 7% level. As always though, do let me know your thoughts in the comments below. Is this one you're looking to add, maybe one you're looking to sell, or it's on your watch list for other reasons, whether it's for the price drop or whether or not it is for that earnings as well. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, drop us your thoughts in the comments below, and we'll see you all on the next one.